Hello, this is Colette Murray presenting the second half of our internal and external analysis report on CenturyLink. This is a presentation co-authored with Cynthia Cundiff for our WSU Management Topics 590 course. The primary competitors we chose to analyze include AT&T, Verizon, and Frontier Communications. AT&T and Verizon dominate the U.S. telecom industry in first and second place respectively, with CenturyLink in a distant third. Frontier, while a much smaller company, is a competitor CenturyLink needs to defend against, as Frontier targets the rural, residential, and small business customers often underserved by industry leaders. Competition in the telecom industry is fierce, and market overlap is significant. CenturyLink, AT&T, and Verizon compete directly in the business and consumer segments of wireline and broadband services. The business segment is the most lucrative and highly sought after, as it generates the highest revenues with customers who are generally not price sensitive and suffer high switching costs. According to Ray Sheffer from MarketRealist.com, business wireline services give stable revenue streams and profitability. Also, they have long contracts and better margins compared to consumer services. Geographically, CenturyLink competes well in suburban and rural markets against smaller regional carriers like Frontier and Windstream. AT&T and Verizon dominate and compete fiercely against each other in high-density urban markets where they have been well established for decades. CenturyLink faces significant risks from wireless communication service providers like AT&T and Verizon, who are threatening its legacy wireline services. As a result, CenturyLink is increasing focus on serving a broader range of business, governmental, and wholesale customers. Financially, AT&T reported 2016 revenues of $163 billion, and Verizon reported just shy of $126 billion. The same year, CenturyLink reported $17 billion, and Frontier just under $9 billion. Each of these companies is suffering net income losses year over year, showing signs of the industry trend of declining sales as customers look to alternatives such as Netflix or Comcast. Given the wide variation in size of these companies, we must use financial ratios for a more effective comparison of how each is performing. However, ratios should be carefully reviewed, as they can give mixed signals about a company's financial stability. Management, product, and competitor forecasts should also be considered, although we are not able to cover those in this short presentation today. We will review return on equity, debt-to-asset ratio, and current ratio for each of these four companies in this analysis. Verizon looks to be the strongest company. Their revenue is not quite as high as AT&T, but their ratios are much better. Their return on equity is 57%, which is outstanding. They are in line with their debt-to-asset ratio and just under the industry average for the current ratio by 0.13 points. AT&T comes in a strong second place to the competitors listed. Their return on equity is higher than industry average by 5%. Their debt-to-asset ratio looks good, well under 1. Their current ratio does need some work there at 0.76, and the industry average is just over 1. CenturyLink comes in third. Their return on equity ratio averages out over the 3-year period to fit within the industry's average of 5.6. Their debt-to-asset ratio is good, they are not over-leveraged, and their current ratio is close enough to 1 that CenturyLink needs to make sure they keep their sales strong and do not over-leverage with debt in their pursuit of acquisitions and new technologies. Frontier Communications is the least financially sound of the competition. Their ratios show that they are not a strong company right now. They need to make some hard decisions to get back on track. They have a negative return on equity, their debt-to-asset ratio is the highest of the group at 0.61, and their current ratio is the lowest at 0.68. The jump in their 2015 current ratio was due to an $8.4 million restricted cash, when the years on either side of it had zero restricted cash. Overall, their liquidity is not very good, and they may face an uphill battle in financing future growth endeavors. All of this tells us that Verizon is positioned very well for continued investment in network growth and critical technology advancements without needing to borrow funds or sell more shares in order to do so. AT&T is also well positioned with ROE that exceeds the industry average. CenturyLink will likely need to continue borrowing in order to grow competitively in the coming years, while Frontier may face significant challenges in raising capital to remain a relevant player. They may become an acquisition target in the near future. CenturyLink's key problem currently is a pending merger with Level 3. This merger brings significant risk of financial loss and limitations to future growth if the merger is terminated. CenturyLink is depending on this merger to add 200,000 route miles of fiber to its network, thereby expanding its customer base and service offerings in the highly competitive business services market. CEO Glenn Post III believes this merger will increase the company's revenues from business customers to more than 75% of the combined company's revenues. If the merger is terminated, CenturyLink will not have the expanded network necessary to handle heavy internet traffic to effectively compete with AT&T and Verizon. Additionally, Post states that CenturyLink is looking forward to realizing significant tax benefits of Level 3's prior net operating losses to substantially reduce the combined company's net cash tax expense for the next several years. Considering CenturyLink's high debt levels and variable interest rate, the company needs to maximize free cash flows in the near term in order to ensure its ability to make the necessary payments on those debts. Finally, if the Level 3 merger is terminated, CenturyLink risks significant consequences resulting from opportunity costs. They may miss other more lucrative opportunities while focusing on the Level 3 acquisition. Key employees and customers may leave CenturyLink if they lose confidence in the company's ability to grow without Level 3's assets. And just yesterday, August 17, 2017, CenturyLink was the worst performing stock of the day in the S&P 500, dropping by 7.2%. on reports that the merger could be delayed by California regulators. There is no way for CenturyLink to guarantee federal and state approval of the Level 3 merger, so to limit the risks as outlined above, it is recommended that CenturyLink take the following steps. First, sell off their obsolete wireline products to stay head-to-head with the wireless competition. To do this, CenturyLink will need to focus on new and emerging technologies. They'll need to replace their legacy income with up-to-date services that consumers demand. This will occur through centralizing and modernizing their networks, including but not limited to replacing copper with fiber optic cables. Number 2, immediately pursue means of refinancing their long-term debts that have variable interest rates in order to increase free cash flows for network investments or alternative acquisition targets. CenturyLink needs to financially position itself to make strong investments in network infrastructure and technology by whatever means possible in order to compete successfully in the business segment. Third, seek alternative acquisition strategies to increase business customer market share that do not require FCC and state approvals. Business customers demand high-speed, huge bandwidth, and security which can be achieved through acquisition of data centers. If CenturyLink can offer an increased number of robust data centers, it can reduce operating costs by essentially eliminating a significant middleman that all competitors rely on. Of these three, the best recommendation is to seek alternative acquisition strategies to increase the business customer market share, particularly alternatives that would not require FCC or other regulatory approvals. An enticing target is Equinix Incorporated, a global data center behemoth valued at $31.1 billion. Level 3 is valued at $21.1 billion for perspective. Equinix currently serves AT&T, Level 3, and T-Mobile, as well as numerous cloud and IT service providers such as Amazon Web Services and Oracle. An acquisition in this arena would launch CenturyLink into a new level of business services capabilities, while also increasing revenues through sales to its current competitors. Implementation of this strategy would require a large amount of capital, so again, CenturyLink needs to focus on reducing debt and increasing cash. Unfortunately, CenturyLink can do little to pursue this option without signaling their intentions while the merger with Level 3 is still active. CenturyLink management should begin by researching the financial health, management structure, and growth strategy of Equinix to better gauge the potential success or pitfalls of an alternative merger such as this. This is the conclusion of our presentation. Thank you very much for your time.